Hey folks, this is David Frost, mystrategicforecast.com. Welcome to another episode of Common Sense Technical Analysis. Let's begin and take a look at the chart of the SPY as we normally do. You're looking at a daily chart, and again, you're looking at a bullish pattern, or not necessarily a pattern, but you're looking at a bullish chart. It's in an uptrend. It's above the 20, the 50, the 200-day moving average. There's really nothing wrong here on a daily basis with the market. Even if we move over to a longer time frame, you're going to see more strength. There's nothing wrong with this market. You know, you could have said down here, basically, 35 points ago, 350 S&P points ago, that the market looked toppy and it should pull back, and it didn't. So there's no reason to expect that it will. We know it will. It's just not yet. Anything can happen on any day, but our big turn, we're still towards, and I say the latter part of June, beginning of July, to be safe. So between now and then, the market could have a pullback. It could have a spike high. We could go up another 100 points on the S&P if we get like a panic buying scenario where people just think they're missing the rally, therefore they have to buy in, and it causes, a heavy volume spike for a couple of weeks. And that's certainly possible in this scenario because you're getting more and more folks out there that believe that the market just can't come down, and it will viciously, but not right now. And that's why we're kind of in no man's land. So we have to trade the market carefully. We're going to pick our spots. We're going to pick our stocks. We're going to pick our spots. And we're going to talk about a stock in particular right now, since we're on the topic of stocks. Let's go over to Twitter, because I gave out publicly Twitter last, I think it was Thursday, and I gave it out over here. Where was Thursday? I think it was the 22nd. So we're in at about 31 and a half, okay? And basically we're at 30, where did we close today? We closed today 33.77, okay? So that's a nice two and a quarter point gain on a $31.50 purchase, which is about 7.5% off the top of my head. I didn't even do the calculation yet. And A, it's not done yet, potentially, but I'll tell you how to play it in a second. And B, told you all along, we see this time and time again. This is a bullish pattern, okay? You have basically, from a daily chart perspective, okay, you have an up move, and now you're moving sideways to down, but you never take out the last low. And as long as this chart stayed ahead of that last low, above that last low, and I said you're a stop out below 29.50. I think I said 50. It's 51. A close below that on a daily basis, and you were out, but it never closed below there. It never got to that point. And lo and behold, about 3 days later after the trade, we get an upgrade of the stock by one of the investment banks, and all of a sudden the stock's up almost 3 points today. Or was it up more than 3 points? I even forget. It's not important. Anyway, so, was it the upgrade that sent the stock up, or was it the pattern that we saw in advance that sent the stock up? And you know how I feel. Our members and subscribers had a nice hit on this stock. So here's how you play it. What we recommend is you take half off the table. A lot of people took half off the table today. You could take half off the table tomorrow, and then you put a stop in, either a mental stop, or if you're watching the market all day, it's a mental stop. If you're not able to watch the market all day, you put a stop in inside the money or above the buy price that you put in, and you let it go. And you keep moving the stop up as the stock moves higher. It's called a trailing stop. So what happens is, if the market, let's say Twitter goes up for 3 or 4 days in a row, okay, there's nothing that says we can't reach this gap window here at about 36.20, okay, and there's nothing that says we can't get to this gap and fill it at 38. Okay, so 38 is probably a little bit out there upside target, but a couple 3 days in the market, a couple of pile-ons on Twitter from some of the hedge funds and momentum traders out there, and this thing can go up another $3-4 in a minute. So it's a good trade. Everybody that took the trade and made money, congratulations. It's a great trade. We're hoping to have more. Obviously, we're going to have more, but I just wanted to let you know what this looks like and where to go from here. Let's move over and see what happened in the oil market today. We're going to look at USO, and right now we have a little bit of a down day in USO, but still in an uptrend. There's no trade here. There's no downside target. This is not in a downtrend. We don't short stocks at highs, at least recent highs, right? We know that. And if you look out on a longer term basis, the picture's a little bit different because you're not into this high here. Okay, so as long as we're beneath this, I would still say this is setting up for a higher, lower high, but we're not there yet. So we could have another few weeks in the oil market. Anything goes. We know the geopolitical events that take place, and we don't want to get in front of those until we have a really, really good trade set up, and then we will get in front of it. But for now, it's a no trade, and so as such, we leave it alone. So let's go back to the daily chart. Let's bring up the chart of gold. I know a lot of folks are interested in gold because we have a lot of gold owners, gold bugs out there, and you know, I said that gold looked bearish. It did not look bullish. It was a no trade, and lo and behold, it sold off, and it sold off for the last couple of days, and we're into some support. There's definitely some support around the 120 to 121 area. There's no doubt about that, but lower prices in gold's not out of the cards. 115's not out of the cards. So this is a no trade. There will be a time to buy gold. We will get bullish on gold this year, in 2014, but not now. So we're going to leave it alone. We're just going to let the market tell us what to do. The market was telling us not to buy gold. Below moving averages, a bearish pattern, sideways consolidation after a down move. There's nothing to buy, and that's the reason why, because now we're going down. So we're going to wait for a pattern to emerge, and then if the timing is right, we'll take a long play on gold, but not now. Let's go over to the interest rate market because there was a lot of talk on the interest rate market today, and we're going to start out with the 10-year. And I think I missed a symbol there, TNX. Okay, so we have the 10-year, and the yield came down today to a low of 243. Now, I think that's a low. I think there's not much more downside. I think maybe 240 in the high 230s, possibly 238 to 240. But more than that, I just can't see it. Let's go over to a longer term chart. We'll go over to a weekly first and take a look at what we see, and then I'll explain myself. Weekly chart's not coming up. Okay, so we're back to the daily. We'll look at the weekly on the how about this? How about we look at the weekly on the TLT, which is a really close representation. So this is the opposite of interest rates. Before we were looking at interest rates, now we're looking at the bond. Essentially, this is an index that supposedly has bonds inside. So you're looking at the price of bonds going up as interest rates go down. And here I think we hit, let's see what we hit as a high today. 114.84, we're almost at 115. We took out the high from last week, and I thought we had put in a high, but apparently we didn't. But again, because I think rates are just about at a bottom, excuse me, I'm not getting scared out of this trade because I think it's just what I'll call a blow off top. Now, if we get, let's go over to the weekly chart of a TLT. And, you know, here's all this support in here, and I just think it's going to have a tough time maintaining this uptrend, and we're not getting up here. That's just not in the cards. Let's take a Fibonacci retracement, and I'll show you what we're looking at and where we are. So we take a pivot high to, this is not exact, it's close enough though. We came into a 38.2% retracement, and we did stall out. But now we're headed higher. Can we go up to the 50% retracement at 116.60? It's possible, sure, we can. It's really only $1.50 away, $2 away. But that would mean another big down move for rates, and it's possible. I'm thinking we're at an extreme. This is a way oversold rate market, overbought bond market, and I just think it's ripe for a pullback. So I'm going to stay with the TBT trade that I gave out publicly also. And that's inverse the bond market. So as rates go higher, TBT will go higher, and we're not going to get scared out of that just yet. We're slightly out of the money, but really only by less than $2, and we're not worried about that. We will abide by our stop rules, but we're nowhere near our maximum stop out of 10%. So we're going to stay with that trade, and that's the interest rate market in a nutshell. I mean, it's the bond market's going bananas, and that's why nobody can figure out the disconnect between the stock market going up and the bond market going up, and all the bond followers out there saying, well, that spells trouble for the stock market. And you know what? They're right. But what's going to happen first is it's going to be a fake out. And but it does spell trouble for the stock market, but it's not today. It's not right now. We're not going to have trouble this week. We're not going to have trouble next week like we're going to have in the summer months. And that's my story, and that's still what the analysis tells us. And that's the and until further notice, until the charts tell us something different, until the markets, all the analyzing I do, and all the indicators I use, until those things tell us something different is happening, we're staying with what I believe to be a cycle top due in, we'll call it early July. So that's it for today, folks. Appreciate you stopping by. We'll see you on the charts. Happy trading.